Welcome to PhillipCapital Experts Talk. My name is Lin Sin from Phillip Securities Research. Today we are privileged to have Mr. Nilang Mehta, one of the fund managers managing HSBC GIFT India Fund, from HSBC Global Asset Management, to take us through the investment prospect of Indian equities. Just a brief background of Mr. Nilang. Mr. Nilang Mehta has been working in the industry since 1996. Prior to joining HSBC in 2004, Mr. Nilang has worked at Alliance Capital Asset Management and IDBI Principal Asset Management, both in India. He holds a master's degree in commerce from the University of Mumbai and is also a fully qualified chartered accountant and a CFA charter holder. Thank you, Mr. Nilang, for taking time to attend this interview with us. India's benchmark stock index, among the top gainers globally last year, has been the world's worst performer over the past month. Oil price movement, which was once a tailwind to the Indian economy last year for bringing down inflation and brighten its economic prospects, is now negatively affecting the Indian equity market. Notwithstanding that, a decline in industrial activity and the minimum alternate tax being demanded from some foreign investors have stoked heavy sell-offs in the stock market. Almost a year into his term of office, Prime Minister Narendra Modi's administration has managed to seal very few major legislative victories. He faces difficulties in passing legislation through the opposition-controlled upper house despite winning control of the lower house. Could you share with us your near-term view of the Indian economy?
Thank you very much for your question. While there has been some amount of opposition to passage of bills, our view is Mr. Modi and the government has done a fantastic job in getting the bills cleared. To give you a few examples, the coal and the mining bill got cleared, which opened up the coal sector to private miners. We also had the insurance bill which got cleared, where FDI investment in insurance sector was up to 49%. So it wouldn't be absolutely correct to say that he has faced opposition. But I understand the point where the near-term concerns come from, where few of the recent legislatures have not been passed. I think government is proactively working on it to get them cleared. In terms of the economy, we think economy is in a very good, getting into a very good shape. Mr. Modi, with his focus on reviving investment cycle, and also the Reserve Bank of India looking at interest rates cuts as we go ahead, we think economy is bottomed out and economy growth in India should pick up.
How about the inflation and twin deficit issues?
Yeah, so the twin deficit is an issue of the past, in the sense that in 2013, if you recollect, India was put in Fragile 5. Now we think India from Fragile 5 is fighting fit. And why I say that is because inflation from double digits have come down to now single digits at around 5%, and we expect it to remain here, which will help Reserve Bank of India to cut interest rates. And on the fiscal deficit which was at 5.8% has now come down to 3.8%. So there has been 200 basis points improvement on fiscal deficit, and the government is further targeting this fiscal deficit to go to 3% over next 3 years. On the other side, current account deficit has also come down from 4% plus to now 1.5%. So these issues have been well taken care of, partly by the measures taken by the previous government, partly by the fall in oil prices, and partly the new government's initiatives.
There were lots of buzz around on possible triggers to the recent market correction. Some attributed it to investors losing faith in the Modi's magic. Some are of the view that investors' expectations were unrealistic and the correction reflects expectation adjustment, and it could even possibly be sheer profit taking. Could you share your stance on the Indian equities market?
So recent correction has been pretty sharp and pretty noteworthy. So markets have corrected by around 10-12% in dollar terms, and that we believe creates a good opportunity for investors to look at Indian equities afresh, considering a lot of high expectations have now got normalized. So while Modi came with a very high expectation, as you rightly managed, he has delivered on few things, but the economy has taken a little bit longer to turn around, considering the past slowdown, which was so severe and deep. We believe going forward, companies will be able to benefit out of the economic recovery, and corporate earnings, which have slowed down, will pick up on back of corporate margins, profit margins improving. So in next couple of years, we are looking at earnings for companies will grow by 15-20% on an average, with GDP growth rebounding back to 6.5 to 7.5% range. And that puts valuations in a compelling position to be looked at.
With Indian rupee falling towards 20-month low amid capital outflow, in your opinion, would it be a good time now to enter the market?
As I said, capital outflows have not happened out of India. India has seen almost $55 billion of inflows on fixed income and equities since January of 2014. Out of that, 45 billion have come through post-election, Modi's victory. And in current year 2015, we have seen around $12 billion of debt and equity flows into India. It's only in May so far there has been some marginal outflows, and hence as a percentage of overall flows which has come into India, there's been no meaningful outflows, I would say. Having said that, the stance on the rupee is Reserve Bank of India is looking to keep rupee reasonably valued, fairly valued, which will help the exports. And it is also on reserve accretion mode. So India in last 18 months has accreted almost 75 to 80 billion dollars of foreign exchange reserves. From lows of $250 billion, we have gone up to $350 billion. So as RBI has propped up for dollar reserves, we have seen rupee remaining marginally has depreciated or remained stable. So on a year-to-date basis, I would say rupee is actually one of the better performing currencies. It's just depreciated 1% compared to a lot of other currencies have depreciated much larger. So it won't be again fair to say that there's been very severe pressure on rupee in my view.
What could be the possible upside trigger?
Yeah, so one key things we are looking at, I think so government's sheer focus on reforms and getting the investment cycle up and going is going to translate into better GDP growth as we go ahead. GDP growth has bottomed out and we see GDP growth improving. We see inflation is likely to be lower than what RBI is looking at. So RBI is looking at around 6% inflation. In our view, most likely we will end the year, if monsoon is not too bad, inflation should be at around 5%. So which will help RBI cut interest rates more than what street and RBI itself is today guiding towards. So that's another trigger. And thirdly, I think it's also the government reforms which is on implementation of GST and key other measures which will help boost the confidence further into Modi and Modi's government as well.
Which sector or industry that you are optimistic on?
Within, if you look at the market as a whole, market as a whole looks fairly valued. Within the market, there are sectors which are extremely cheap compared to their historical valuations, maybe trading at historical low valuations, which are the cyclical companies, the financials, the materials, the industrials. And at the other hand, we have the expensive sectors, which are trading at historical high valuations, mainly consumer staple companies, healthcare companies. So our focus is, since we expect economy to recover, interest rates to get cut, we are more positioned in the cyclical sectors. So sectors we like are financials, consumer discretionary, materials and energy.
Following your earlier comments on the Indian rupee, the looming US interest rate hikes that may aggravate the capital outflows and put pressures on Indian rupee, what are the risks to monitor?
Rising US interest rate is one part of the equation, and we have been waiting for US to raise rates for a long period of time. Our view is US rates will go up, but they are going to go up very gradually. And at the same time, we have the other large economies of the world easing. So we have the Europe zone which is easing. We have Japan who's been easing interest rates, and we have already started to see China cutting rates quite severely. So part of the US interest rate hikes will get compensated by the other large economies or the other economic blocks easing. So to that extent, I believe capital outflows should be moderate. The key risks going forward is definitely going to be the upcoming monsoon. So if India faces poor monsoon, then that could impact the rural economy a bit, and that's where the risk is. And if US economy, as of now it doesn't seem so, but if it grows much more than expected, then if that leads to higher than expected raise in interest rates, there could be another risk to watch out for. But the later, I think, is a little bit unlikely to happen.
How should investors position themselves to manage the downside risk?
So while in investing, we can't definitely eliminate all the downside risks, but what we can be aware of these risks. The best way to look at is investing when markets are cheap, and the companies which are cheap and their valuations are reasonable. So the way I look at it, the current correction, if you're buying something cheap, 10%, 15% lower than where it was, it's a good opportunity to enter into markets. So by buying something cheap, I think so that's the best way to mitigate the risk of downside.
Referring to the monsoon risk you have mentioned earlier, should investors avoid agricultural sector related stocks?
So we do not have direct plays on agriculture in Indian market. So there are indirect plays, while rural finance companies which finance tractors, we have fertilizer companies, we have crop protection companies, and so on and so forth. So that's the way to invest in agriculture if one wants to explore. Again, as a sector, there will be opportunities. So there will be good companies going through a good phase, and there will be companies which will be having a bad profit cycle. So the way we will approach it, we go company by company. So which company has good potential, at the same time where valuations are more reasonable, and focus on them rather than see agriculture as one sector and invest in that.
Thank you, Mr. Nilang, for sharing your insights with us here today.
Thank you very much. Appreciate it.
For more information on unit trust, please log on to www.eunittrust.com.sg or talk to us at any Phillip Securities branches. Thank you.